Good evening, ladies and gentlemen. A very warm welcome to ICICI Lombard General Insurance Company Limited Q4 and FY 2025 earnings conference call. From the senior management, we have with us today Mr. Sanjeev Mantri, MD and CEO of the company, Mr. Gopal Balchandran, CFO, Mr. Girish Nayak, Chief Technology and Health Underwriting and Claims, Mr. Sandeep Koradia, Chief Corporate Solutions, International Bank Assurance, Mr. Anand Singhi, Chief Retail and Government Business, Mr. Gaurav Arora, Chief Reinsurance, Underwriting and Claims for Property and Casualty. Please note that any statements, comments are made in today's call that may look like forward-looking statements are based on information presently available to the management and do not constitute any indication of any future performance. As future involves risk and uncertainties which could cause results to differ materially from the current views being expressed. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance in the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. I now hand the conference over to Mr. Sanjeev Mantri, MD and CEO, ICICI Lombard General Insurance Limited. Thank you, and over to you.
Good evening to each one of you. Thank you for joining the earnings conference call at ICICI Lombard General Insurance Company Limited for Quarter 4 and Financial Year 2025. Let me give you a brief overview of the trends we observed in the economy as well as the industry, followed by an overview of the business. Post this, our CFO, Mr. Gopal Balachandran, will share the financial performance of the company for the quarter and the year ended 31st March 2025. The GDP growth for the quarter ended December 2024 stood at 6.2% versus 5.6% for the quarter ended September 2024, as per the data released by MOPSI. High-frequency indicators like e-way bills, toll collections, diesel consumption, and GST collections during Quarter 4 of Financial Year 2025 are all indicating positive economic conditions. Further, MOPSI has revised the full-year GDP estimates to 6.5% on Feb 28, 2025 versus 6.4% published on Jan 7, 2025. Let me now dwell on certain industry trends which can have an impact on the general insurance industry at large. As indicated during the last quarter, the government expenditure remained flat, which impacted the commercial line segment growth for the current quarter. However, we have started seeing an uptick in government spending towards capital expenditure in past few months. This may be a positive for the commercial line of business. For the auto industry, we had seen a growth in rural market in Q3 of 2025, specifically for two-wheeler segment at 12.7% and the tractor segment at 20.1%, as reported by FADA. However, in Quarter 4 2025, we have seen a degrowth of 1.9% for the two-wheeler segment and a degrowth of 4.6% for the tractor segment. This indicates a softer rural demand. The private car segment grew by 1.1% and the commercial vehicle segment had a degrowth of 3.8% for Quarter 4 Financial Year 2025, as reported by FADA, which had an impact on motor insurance growth for Quarter 4 Financial Year 2025. However, for the coming year, the auto industry is expected to have mid-single-digit growth. We remain positive for the motor insurance business with increasing penetration in the old vehicle segment. The health segment continues to be one of the fastest growing segments and is the largest contributor to the industry, constituting 38.1% of the GDP mix for financial year 2025. However, the industry growth in financial year 2025 was impacted due to the 1/n accounting norm and lower growth in the health benefit segment attributable to lower disbursement of credit by NBFCs and MFIs. We believe that the increasing demand for health protection coupled with increased medical inflation may drive double-digit growth in the health segment in the coming year. There were some key economic changes which were announced during Quarter 4 Financial Year 2025. The budgetary announcement of income tax relief provided is expected to result in an additional 1 trillion in the hands of Indian tax-paying population, thereby leading to a high disposable income. The second consecutive interest rate cut, tweaking of norms applicable to NBFC lending, coupled with infusion of liquidity by RBI, should also support credit growth. These policy changes aim to encourage spending and investment. They are also expected to stimulate demand for goods and services, thereby boosting consumption and propelling demand for risk protection through insurance solutions. However, we remain vigilant on the ongoing geopolitical developments which may pose risk to both global growth and the Indian economy. Now let me give you an update on the regulatory developments. The authority during financial year 2025 continued with various reforms seeking to expand the market and increase the penetration of insurance products towards the mission of insurance for all by 2047. I would like to mention key circulars which were introduced in Quarter 4 2025 regarding capping the increase in senior citizen health insurance premium rates to 10% per annum and the introduction of Bima Asba facility for health insurance policies. We believe these regulatory changes will improve affordability and create operational ease for policyholders. Overall, we remain positive that the GI industry is poised to grow in the medium to long term given the favorable economic and regulatory environment, low penetration and relatively higher disposable income. Now coming to the industry performance for Quarter 4 and financial year 2025. The gross direct premium income grew by 1.7% and 6.2% for Quarter 4 2025 and financial year 2025 respectively. Excluding the impact of the 1/n accounting norm, the GDPI grew by 8.6% for financial year 2025. Excluding crop and mass health, the GDPI grew by 4.9% and 8% for Quarter 4 2025 and financial year 2025 respectively. Speaking on the specific segments within the industry, the commercial segment reported a marginal degrowth of 1.2% and growth of 1.5% for Quarter 4 and financial year 2025. Within this, the fire segment registered a degrowth of 1.8% and 5.3% for Quarter 4 financial year 2025 and financial year 2025, respectively, on account of pricing pressure. Excluding the fire segment, the overall commercial segment grew by 8.5% for financial year 2025. The motor segment grew by 6.9% for Quarter 4 of financial year 2025 and 8% for financial year 2025. The growth in the segment has been lower due to muted vehicle sales and continued pricing pressure reflected by high industry combined ratio. The health segment grew at 3.7% and 9% for Quarter 4 2025 and financial year 2025. Within this, group health grew at 4.5% and 10.6% for Quarter 4 2025 and financial year 2025 respectively. And retail health grew at 7.6% and 12.1% in Quarter 4 2025 and financial year 2025 respectively. Looking at the underlying performance of the industry, you may recall our discussion a year back during our earnings call where we expected some semblance in underwriting discipline in the market due to improvement in the industry's combined ratio during that period. However, the combined ratio for the industry has actually worsened to 113.2% for 9 months 2025 as against 112.2% for 9 months financial year 2024. The combined ratio for the private sector has worsened to 111.21% for 9 months 2025 from 108.3% for 9 months financial year 2024. The industry worsening was largely due to motor segment combined ratio, which increased to 123.8% in 9 months financial year 2025 as against 118.2% in 9 months financial year 2024. Our continued focus on driving profitable growth helped us to improve our combined ratio from 103.7% in 9 months financial year 2024 to 102.8% in 9 months financial year 2025 and 103.3% in full financial year 2024 to 102.6% in for the financial year 2025 on N basis. I will now walk you through the company performance across key business segments during Quarter 4 and financial year 2025. The company's GDPI registered a growth of 8% for Quarter 4 2025 and 11% for financial year 2025 on N basis. With the 1/n accounting norm for Quarter 4 2025, the company registered a growth of 2.3% as against the industry growth of 1.7%. And for financial year 2025, the company registered a growth of 8.3% as against the industry growth of 6.2%. Excluding crop and mass health, the company's growth was 2.2% and 7.7% compared to the industry growth of 4.9% and 8% for quarter 4 2025 and financial year 2025 respectively. In the commercial line segment, in quarter 4 2025, our growth was at 2.8% as against the industry degrowth of 1.2%. For financial year 2025, we grew by 2.1% as against the industry growth of 1.5%, thereby maintaining market share. This indicates the strength of our brand, relationship and service quality in an environment where the industry faced continued pricing pressure throughout the year. In the fire segment, we grew in line with the industry, and in marine cargo, engineering and liability lines of business, we reported growth higher than the industry, leading to market share accretion. In motor segment, we grew at 0.1% for quarter 4 2025 as against the industry growth of 6.9%. We continue to drive our motor strategy based on granular portfolio segmentation and prudent risk selection. For the financial year 2025, we grew by 11.5% as against the industry growth of 8%. Consequently, our market share grew to 10.8% for financial year 2025 versus 10.5% for financial year 2024. The portfolio mix for private car, two-wheeler and CV stood at 53.4%, 25.4% and 21.2% respectively. Our continued focus on multi-channel distribution, underwriting capabilities and efficient claim settlement and actuarial practices helped us in maintaining our leadership position. Moving to the health segment, we grew by 22.1% and 19.2% for quarter 4 financial year 2025 and financial year 2025 respectively. With the 1/n accounting norm, we grew by 9.7% and 12.6% for quarter 4 2025 and financial year 2025 respectively. Our retail health segment registered a growth at 47.7% for quarter 4 financial year 2025. With the 1/n accounting norm, the growth of quarter 4 2025 was 25.1% as against the industry growth of 7.6%. For financial year 2025, the overall growth stood at 38.1%. With 1/n accounting norm, the growth for financial year 2025 was 25% as against the industry growth of 12.1%. As a result, we gained market share from 3% in financial year 2024 to 3.3% for financial year 2025. The group health employee segment witnessed growth of 24.9% and 18.5% for quarter 4 2025 and financial year 2025 respectively. Our group other business degrew by 5.5% and with the 1/n accounting norm, the degrowth was 30% for quarter 4 2025. For financial year 2025, group other business had a muted growth of 5.3% on account of impact on health benefit business through the banker channel. With the 1/n accounting norm, this segment showed a degrowth of 10.5% for the year. We had spoken about various One IL, One Team initiatives in our earlier earnings call. One of the initiatives we had spoken about was the consolidation of customer-facing digital assets like IL Take Care Health app, website and digital alliances under One IL, One Digital to deliver a superior customer experience and to drive efficiencies. Some of the digital outcomes achieved in financial year 2025 include increasing unique customer visit by 2x on our digital platform, 37% growth in fresh transactions on our digital platform, downloads for our one-stop solution, One IL Take Care app, surpassed 14.9 million. The business done through the app stood at 927.7 million and 2653.2 million for quarter 4 financial year 2025 and financial year 2025 respectively. Consequently, our customer-facing digital asset business grew by 15.8%, constituting 6.6% of our overall GDP for financial year 2025. Now I would like to share with you some initiatives taken by us for improving the customer experience and driving efficiencies for claims. On the motor side, our preferred partner network serviced 74.1% of our non-OEM claims in quarter 4 2025, up from 69.6% in quarter 4 2024. For financial year 2025, this number stood at 73.2%, up from 65% in financial year 2024. Our cloud calling facilities were used by 89.6% of our motor customers in quarter 4 financial year 2025, as against 77% in quarter 4 2024. For the full year, this number was at 86%, as against 49% previous year. This resulted in a reduction of calls to claim ratio by 21% for the year. Our average claim settlement period for retail lines of business has seen improvement from 6 days in financial year 2024 to 5 days in financial year 2025 for motor OD and from 5 days in financial year 2024 to 3 days in financial year 2025 for health. Our ICICI initiative, which was launched in April 2024, offered an on-ground claim support to over 90,000 customers across 56 cities and 2,500 hospital network in financial year 2025. Our focus on customer experience and process efficiencies has led to healthy NPS of 67 and 69 for health and motor claims respectively for 9 months 2025. With all the above efforts, we are pleased to share that the company's premium growth has been higher by 210 basis points as against the industry growth. Our focus on driving profitable opportunities has further resulted in improvement in the combined ratio from 103.3% in financial year 2024 to 102.6% in financial year 2025 on N basis. On the 1/N accounting norm, the combined ratio stood at 102.8%, leading to a PAT growth of 30.7% and a delivery ROE for the year at 19.1%. As we enter into the new financial year, we remain committed to achieving the desired scale through creation of positive customer experiences, leveraging data analytics, and a technology-first approach, harnessing our multi-product, multi-distribution strategy, and with a continued focus on product innovation. With our core philosophy of one aisle, one team, we continue to scale up the profit pools and to drive sustainable growth. I will now request Gopal to take you through the financial numbers for the recently concluded quarter and financial year.
Thanks, Sanjeev, and good evening to each one of you. I will now give you a brief overview of the financial performance for the recently concluded quarter and the financial year. We have uploaded the results presentation on our website. You can access it as we walk you through the performance numbers. With effect from October 1, 2024, long-term products are accounted on a 1/N basis as mandated by the regulator. Hence, Q4 and FY'25 numbers are not comparable with prior periods. For more details on the impact, refer to slide number 15 of our investor presentation for further details. The gross direct premium income of the company was at rupees 268.33 billion in FY'25 as against rupees 247.76 billion in FY'24, a growth of 8.3% as against the industry growth of 6.2%. GDP of the company was at 62.11 billion in Q4 FY'25 as against 60.73 billion in Q4 FY'24, a growth of 2.3% as against industry growth of 1.7%. On the retail side of the business, GDP of the motor segment was at 107.4 billion in FY'25 as against 96.34 billion in FY'24, registering a growth of 11.5%. The advance premium for the motor segment was at rupees 37.17 billion at March 31, 2025 as against 36.44 billion as at December 31, 2024. GDP of the health segment was at rupees 69.5 billion in FY'25 as against 61.71 billion in FY'24, registering a growth of 12.6%. Our agents, which includes the point of sale distribution count, was at 1,40,736 as at March 31, 2025, up from 1,40,077 as at December 31, 2024. GDP of our commercial line segment was at 69.95 billion in FY'25 as against 68.51 billion in FY'24, registering a growth of 2.1% as against industry growth of 1.5%. Resultantly, our combined ratio stood at 102.8% for FY'25 as against 103.3% for FY'24. Excluding the impact of cat losses of 0.94 billion in FY'25 and 1.37 billion in FY'24, the combined ratio was 102.4% and 102.5% respectively. Combined ratio for quarter 4 FY'25 was 102.5% as against 102.3% in quarter 4 FY'24. Our investment assets during the quarter rose to rupees 535.08 billion as at March 31, 2025, up from rupees 515.97 billion as at December 31, 2024. Our investment leverage net of borrowings was 3.74 times as at March 31, 2025, as against 3.76 times at December 31, 2024. Investment income was at 42.5 billion in FY'25 as against 36.1 billion in FY'24. On a quarterly basis, investment income was at 8.77 billion in Q4 FY'25 as against 9.54 billion in Q4 FY'24. Our capital gains net of impairment on investment assets stood at rupees 8.02 billion for the full year as compared to 5.51 billion in the previous financial year. Capital gains net of impairment on investment assets stood at rupees 0.06 billion in quarter 4 FY'25 as compared to rupees 1.56 billion in quarter 4 FY'24. Our profit before tax grew by 30% at 33.21 billion in FY'25 as against 25.55 billion in FY'24, whereas PBT degrew by 4.2% at 6.68 billion in quarter 4 FY'25 as against 6.98 billion rupees in quarter 4 FY'24. Consequently, profit after tax grew by 30.7% at 25.08 billion in FY'25 as against 19.19 billion in FY'24. PAT degrew by 1.9% to rupees 5.1 billion in Q4 FY'25 as against 5.19 billion in quarter 4 FY'24. The board of directors of the company has proposed a final dividend of rupees 7 per share for FY'25. This payment is, however, subject to approval of shareholders in the ensuing annual general meeting of the company. The overall dividend for FY'25, including the proposed final dividend, is rupees 12.5 per share. Last year, the overall dividend was rupees 11 per share. Return on average equity was 19.1% in FY'25 as against 17.2% in FY'24. Return on equity for quarter 4 this year was 14.5 as against 17.8 in quarter 4 of last year. Solvency ratio was at 2.69 times at March 31, 2025 as against 2.36 times at December 31, 2024. Continued to be higher than the regulatory minimum requirement of 1.5. As I conclude, I would like to assert that we remain focused on our strategy of driving profitable growth, consistent and sustainable value creation for all our stakeholders, while ensuring that the interest of policyholders is in the forefront at all times. I'd like to thank you all for attending this earnings call, and we will be happy to take any questions that you may have. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question comes from the line of Prayesh Jain from Motilal Oswal Financial Services Limited. Please go ahead.
Yeah, hi. A good set of numbers especially on the combined ratio front. Just your thoughts on how do we see the growth from here? Firstly, from an overall GWP perspective, given the 1/n impact would continue to be there in 1H of FY'26, and second half would see unwinding of the GWP and contributing to some part of growth. So that would be the first question. Second question would be on your combined ratio, whether you would look at combined ratio further improving from the one that reported for FY'25. And third bit on the fire segment, if you could highlight, what are the kind of renewals we've seen in January and also in in the April renewals? Those would be my three questions. Thanks.
Okay. Yeah. Thanks, Prayesh. I think with respect to the growth, even when I was reading in terms of what it is line by line I had covered, but again I'll talk about it. Motor per se, we are expecting on the new sale mid-single digit. We are also going by the numbers as has been put across by other OEMs as to what they are seeing. Albeit the base on the private car in particular is high. I also spoke about the fact that the quarter 4 two-wheeler numbers were negative, which was a bit of a surprise as what we saw in quarter 3. And commercial vehicle, I would be more positive overall because government capex and a lot of other activities which in the last financial year had remained subdued should get picked up. So net motor we will see single digit to maybe at just about double digit growth is what our prediction is. And look, all of these things can change real time. We'll keep you updated, but that's what our belief is. On the health side, Prayesh, our own belief is we should see double digit growth. Now, health has two components, retail health and as well as the group health part of it. I am more clearly talking about the retail health part, which will continue to see far more incremental business in terms of new to insurance, and also there would be whatever inflationary growth that comes out in terms of overall this. So we would remain positive on health, and health with a 38% contribution will not be surprised if we see that contribution probably going to a 40% and thereabout and becomes the largest and will continue to be the largest player. The last but not the least, in terms of the commercial line of business, we've had one of the most difficult years on commercial line if you see. We've never seen a growth of this nature going to, low single digit in last 7 to 8 years. Clearly, it had multiple factors, fire pricing, which we spoke about it. However, going forward, as the